Hello. Okay, good evening and welcome to FSM1 webinar on Singapore stocks, growth and stability amid uncertainty. My name is Mark. I'm client investment specialist from FSM1 CIS team. First of all, I would like to thank all the participants who registered and joined this Tuesday evening webinar. Okay, before we kickstart our event, just to share with you our ongoing FSM1 promotion. FSM1 promotion, which is started on 18 July until 19 September. You can enjoy a zero processing fee for up to 3 trades when you buy or sell SGX Singapore stocks and ETFs in a SGD currency as long as you are using SGD auto sweep. So what this means that you get to save on your trading costs plus your idle money that you park under your SGD cash auto sweep is also earning a return while waiting to be deployed. So if you are been planning to add Singapore stocks or ETFs to your portfolio, probably this is a good chance to do it more efficiently. And all the details and full terms are available in our FSM1 portal. So probably you can have a look on that as well. So during the webinar, feel free to drop your question at the Q&A tab uh, at the down there so that let our speaker to address your questions that probably you have. So with that, allow me to introduce our speaker, Mr. Timothy Phillips, founder of Team Talks Money. So Tim has over 12 years of experience in the investment industry in various roles, including Schroders and Motley Fool. So he has built out unique insights from his time covering Asian equities, Asian fixed income, and global equities. He is a passionate advocate of responsible long-term investing as a great way to build wealth and has done extensive outreach on this. Probably we are here to learn more on this part as well. Yeah. So Tim is also a certified SGS Academy trainer, and on his spare time, he enjoy running after his two young sons, playing football and practicing yoga. So without further ado, let's welcome Mr. Tim. So Mr. Tim, the floor is yours.
Hi, thank you, Mark, for that intro. Thank you everyone for joining today. I'm looking forward to sharing my thoughts on the Singapore market, which we all know has had a very good year so far. And let's hope the good times continue to roll. But there are many reasons why this has been the case and why the outlook is bright for the Singapore market. So I'm going to share some slides. I will try and make this a little bit more interesting and not bombard you with a 100 slide deck. But I will be talking and throughout. But as Mark said, please do drop in any questions you may have into the Q&A box throughout, and I will get to it in the last sort of 15, 20 minutes. So without any further ado, I will share my slides and then we can get going. Okay. Um, okay, so I am going to be covering Singapore stocks, as most of you are here for Singapore. Growth and stability amid uncertainty. So before I get started, I just want to make sure that everything within this presentation, the usual disclaimer, nothing should be construed as personalized financial advice. If you are going to go out and buy any sort of investment or stock, please do your own due diligence, make sure it fits into your investing time horizon as well as your risk appetite. And goes without saying, size your positions responsibly, et cetera, et cetera. So just to get that out of the way before we start. Okay, so the agenda for today is going to be pretty straightforward. I'm going to give you a quick macro backdrop on what's been happening globally, how that's really perhaps benefiting Singapore. Then I'm going to go on to why the Singapore Exchange has really been a bit of a port amid the geopolitical as well as sort of global economic storm that's brewing. And then I'm going to give you a few ideas from the Singapore market that are popular and that have had quite a bit of momentum in the past sort of 12 to 18 months. So if you do have questions throughout, please don't hesitate, as I said, and as Mark mentioned, to drop them into the Q&A box. Okay, so global macro. What are we dealing with as investors? I think for me, and I assume for most people here, the big event this year was probably April 2nd, Liberation Day. I know this is probably how I felt after the tariffs came out. I'm sure that a lot of people elsewhere felt a similar way, dealing with the typical unpredictability of the Trump administration, not really understanding where it's going to go from here. But the initial reaction was one of shock and maybe anger, as our portfolios got absolutely smashed, down close to 20% within sort of 2 weeks, 3 weeks. There just was a lot of red, right? And so I think that scared a lot of people. There's a lot of uncertainty, and as we all know, markets hate uncertainty. We don't know what's going to happen. We don't know if he's really serious about these tariffs. What does it mean? And in typical Trump administration style, I don't think there was much thought that went into actually planning the tariffs and what it meant. So there obviously were exemptions that were carved out, many exemptions that were carved out, crazy tariff hikes against China, coming to the table, renegotiating that tariff pauses for 90 days, et cetera, et cetera. So there was a lot of to and fro with both allies as well as strategic competitors alike. So it wasn't as though anyone was really spared. It was actually Asia we thought was going to be maybe spared ex-China, right? China we knew was the target really of these tariffs, but it hits Vietnam, it hit Indonesia, it hit Thailand, it hit Malaysia. So all these Southeast Asian nations that a lot of these companies have been moving to outsource production from China or move production from China, actually we got hit as well. So this isn't really setting us up very well for the rest of the year. I mean, April 2nd wasn't really a great event for the majority of investors. We can kind of accept that, right? And we've kind of moved on from that. Obviously, markets have rebounded. US markets have recently hit all-time highs, but it hasn't really detracted from the fact that there are massive issues underlying in the US economy and in the US system. And so the first half, even though there was a rebound in markets initially on the optimism that it's not going to be as crazy as it first seemed, these tariffs, we saw the dollar index, the DXY, have its worst 6 months in sort of nearly 50 years. And so that wasn't a good sign for investors on the whole, because if you have US dollar assets, if you're buying US shares, if you're buying ETFs, I don't know, listed in London or in Europe or in the US, most likely you're going to be buying them in US dollars. And so the fact that the global reserve currency has just had its worst first half in 50 years isn't a good sign for investors. And it's kind of created a lot of unease, I would say, at how much we rely on the US market as a whole. I mean, we know it makes up 65-70% of global market equity cap. That's something we can't avoid just because of the tech giants and the amount of innovation that's going on in the US economy. But it has made people think about where else can we put our money. We don't need to be all in on the US. Had post GFC, which was the obvious play, and it became really the only play post GFC, right after 2009, 2010. US markets really just took off, and there was really no outperforming markets over 10, 12, 13, 14 years if you were in any other global market. But that's changing. That's changing. And the greenback, the dollar index has just had its, as you said, just had its worst first half in 50 years. And that's not a good sign for the US economy. And that's not a coincidence either that gold has just had its best sort of first half in nearly over 40 years. I mean, if you look back to the early 80s, there was a bad dip in gold post the Volcker years, but gold held up nicely in the 70s and 80s because there was a lot of unease and uncertainty around Fed policy, around inflation, very similar to what we're experiencing today. And so if you think about dollar weakness, if you think about gold prices, they have an inverse relationship, right? So if gold tends to do well when the dollar is weak, and the dollar has been weak this year as we've seen down about 10%, and that's really set it up nicely for gold to outperform the markets and the S&P 500. But beyond that, we're seeing the takeoff of other alternative assets, so to speak. So we all know about private equity, we know about private credit. That's fine. That's ex public equities. That's fine. But if we're looking at actual anti USD or anti sort of institutional US institutional assets, it's really stuff like gold. It's stuff like Bitcoin, which has done really well. And Bitcoin typically moves in tandem with equity markets, but it was one asset that didn't post Liberation Day because of that uncertainty. So there was a fall off in the Bitcoin price, but it actually held up relatively well versus the Nasdaq and the S&P 500 because you're kind of seeing a lot of people think about, do they want to allocate even 1-2% to Bitcoin, and are they underallocated to gold, which a lot of people still are. And so this has kind of made people think, where can I put alternative allocations towards? Where should I be putting my money towards? And gold and Bitcoin in an environment such as this has become an obvious place. And I'll touch on why Singapore is really going to become an obvious choice as well for investors. So if we take a look at sort of US interest payments, we know they're out of control. Recently, this is a great chart from Deutsche, just showing the fact that US interest payments in fiscal year 2024, they actually overtook defense spending in the US as a percentage of GDP. So it can kind of show you how much money the US is putting towards actually just paying back its own debt. And we've seen there be desperation from the administration for the Fed to start cutting, the Fed to really bring rates down so that debt burden isn't as strong for the US government and the US federal debt levels. But it's something that is starting to brew, right? It's something that is becoming an issue for markets. And we can kind of see that in play out with the US deficit. We've always had issues with the US deficit ceiling, what's going to happen, how it's going to play out. But if we look over the following time horizons, again, this is an interesting one from Deutsche Bank's research arm that took a survey of institutional professional investors, just looking at what impact the US fiscal deficit will have on markets, say over the next year. Not so much, right? Noise in the background. Notable market influence, maybe without being a huge one, was the majority for the 1 year horizon, the short-term horizon. And typically they kick the can down the road, right? Congress figures out a way to extend or raise the debt ceiling. President signs off on it. There's a lot of to and fro horse trading, but it gets done. But I think we're kind of running up against a potential brick wall in terms of how much more debt they can take on and how much more they can service. And so you can see on the right-hand side, the 5 year horizon, there's significant worry from professional institutional investors, just how much of an issue the US fiscal deficit is going to become. And so that's something that a lot of maybe investors on the retail side haven't thought so much about in terms of how that can impact market sentiment as well as capital flows. But if you look at the institutions in the US right now, they're being eroded by basically President Trump calling into question things like the Fed independence. I mean, we just saw yesterday he tweeted or he posted on Truth Social about firing current Fed Governor Lisa Cook. That is still unsure whether he can actually do that. And then there's been a lot of pressure for him to also put Jay Powell into early retirement. So he's not going to, or most likely not going to, renew Jay Powell's term. He's already been tweeting a lot about Jay Powell should be lowering rates, throwing insults at him. So there's been a lot of questions about Fed independence. And ironically, if he does go down that route of pressuring the Fed and politicizing the Fed, yields are probably going to spike. And actually, it's going to be more expensive to service the debt, even though rates might come down the way he wants. It's not really the way to go about bringing down rates and bringing down the federal deficit. So this is something that is going to play out, but it's difficult to predict because you don't know what Trump is going to do, and I don't think even he knows what he's going to do. So to say that he's not going to do this or that is hard to say, but he cannot seem to control his impulses. And I'd say in the second term, or at least the second presidential term, his impulses are much more out of control because he doesn't really have perhaps adults in the room or institutional politicians that he had in his first term. So there's a lot more of a impulsive Trump, I would say, in term two versus term one, where he was a bit more constrained, a bit more restrained in his actions. Right now, he's not, and he's really taking out on the Fed. And so this is something that could become a much bigger issue, in the near future if it's not dealt with delicately. And so what does that mean for the Singapore dollar? Well, that's actually been pretty good news for the Singapore dollar. It's up 6.4% year to date versus the US dollar. We've seen some headlines. We all know how robust the Singapore dollar is. And so if you're talking about the Singapore dollar over sort of 10, 20, 30 years, Singapore dollar is only one of only two currencies globally out of the major currencies that have actually posted positive returns on a 10-year, 20-year, and 30-year basis versus the USD, versus the greenback. And the only other currency that has done that or been able to achieve that has been the Swiss franc. So the Swiss franc and the Singapore dollar, you can see, are really just very, very robust, solid safe haven currencies that people trust, and they have a track record. It's not something that's happened over the past 3 or 4 years. As I've said, 10, 20, 30-year track record of the Swiss franc and the Sing dollar has shown you that they're the only two major currencies that have actually posted positive returns against a spot greenback. So that's a good sign, I think, for investors to think, do I want to have Sing dollar denominated assets in my portfolio, or should I think about it? And that's what a lot of professional investors and institutional investors have been also discussing. And this kind of a reason why you've seen yields in Singapore really come down strongly. If you look at T-bill yields, even Singapore savings bonds, they've all dropped massively, right? That's a case of lower inflation, of course, but there's demand is still there for Singapore dollar assets, even on lower yielding assets. And that spread between what you can get on a savings account in Singapore dollar versus what you can get for US dollar money market funds or US treasuries, right? That spread is continuing to widen, and there's a reason. It's because Singapore as a currency and as a nation, it's predictable, and we know what we're going to get. And so what has that meant for the Straits Times Index? Well, that's equated to near 20% gains in US dollar terms so far in 2025, right? We're talking about 12, maybe 12.5% up so far in 2025. Add that 6% or so, you're talking about 18, 19% US dollar returns year to date in 2025, and a record high for the Straits Times Index. And so it's really been a story, as you can see, the big drop in April. But beyond that, it rebounded pretty quickly, and then it started to continue its climb upwards. And so the record setting recently of the Straits Times Index, we all know that's down to banks, but it's also down to capital flows that have come into Singapore that are much stickier and are thinking about how to diversify either, well, US equities or how to diversify with high net worth private wealth, right? And so whenever you're thinking about safe havens, you think maybe gold, you think Singapore dollar, you think Swiss franc. So these currencies come to mind, and the Singapore dollar has definitely benefited from that perception and from that shift in investor sentiment. Okay, so why Singapore Exchange? I mean, why is the Singapore Exchange being the port? We all know about the Singapore dollar, how that's worked in its favor. That's pretty obvious. We know the dollar, the greenbacks had a terrible first half. That's pretty straightforward. For most of us, we know the cons of owning the dollar in the first half. But the main reason is Singapore's fiscally responsible. It's not a country that is just blowing its reserves, right? It's not a country that has a massive oil fund and has a massive corruption. It has very strong institutional standing. Nearly zero corruption, very responsible stewardship of funds. And if you think about AAA credit rating, the highest credit rating in terms of credit worthiness for sovereign debt, it's one of only 8 countries globally, or sorry, one of only 10 countries globally that has the AAA credit rating. And it's the only one in Asia. I mean, there is Australia and Asia Pac, and there's Canada and North America. The rest are actually in Europe. So Singapore's the only one in Asia proper that has a AAA credit rating. And it's kind of a testament to how responsible fiscally the government has been, institutions in Singapore have been. And the US recently lost its last AAA credit rating, although that wasn't a shock and markets kind of took it as a non-event. But it really shows that people have lost confidence in the US as being a responsible global actor, a global adult, maybe in terms of geopolitics, in terms of fiscal responsibility. It's really not in the Premier League of credit worthiness anymore. And so it got relegated, as we know, a while back, and then finally lost its final AAA credit rating, I think from Fitch or S&P earlier this year. But regardless, Singapore is very fiscally responsible. But there are some misperceptions out there that Singapore has massive net debt, or it's got a massive gross debt to GDP ratio, which on the actual top headline it does, but that's not taking into account its massive reserves, which it has plenty of reserves. We all know that GIC, Temasek, and what it creates from those reserves as well in terms of income. And so the government here is just coming out with a statement. This was last year, just talking about how it has no net debt, right? It's very much full on in terms of its cash position, but its actual debt the net debt, it has none whatsoever. So its assets actually outweigh its liabilities. And so to have a net cash position as a country now is unique, right? It's quite a strange thing to have. Effectively, a negative gross debt to GDP or net debt to GDP ratio is negative because it doesn't actually have debt on a net basis. So it has a strong balance sheet, as it says, assets in excess of liabilities. So we know that the government is fiscally responsible. We know the Singapore dollar is doing well. So we've got the foundations for a market that should attract investor interest, right? And should really naturally attract investor capital flows. As we say, Singapore's finance is sitting pretty. This is a scene from one of my favorite shows, Succession. Maybe you'll recognize a few of the other gifts that I'm going to be showing. But Singapore's finances, they're in a robust state, and the government on a annual basis, when it does its budget, it's very responsible about balancing the books, ensuring they're not overspending, trying to allocate capital to where it's best sees a return on investment or ROI, whether that's on a social level or whether that's on an economic level. The government really has a very, very strong framework. And I think those institutions that it's built over 50, 60 years, they're really starting to benefit from that strength in this current environment. And as we've seen, inflation is cooling, right? Inflation was hot, I'd say maybe last year and into 2023. It was definitely high, 4 or 5%. It's come down, it's cooled. Core inflation's really cooled down. And that's also coincided with a stronger Singapore dollar, which is not something perhaps you would expect. But the government and the MAS have talked about the dollar being maintained at its current band in terms of its strength. They're not looking to weaken that band too significantly in the near future. And so with core inflation kind of easing, it's kind of in a Goldilocks situation right now for the Singapore economy. Jobs are generally the employment market's holding up. inflation is coming down. Corporates are doing well, and as you can kind of see with the Straits Times Index setting record highs in terms of the market, but corporate earnings have also been really solid in the first half of 2025. And so, what's driving the Singapore market right now? I mean, we know what the big winners are in the Straits Times Index. That's no secret. We know the banks, DBS, OCBC, UOB. Why is that? Because higher rates, that they benefit from that. That's no surprise. Dividends, we love those dividends in Singapore. Investors like the dividends from the Singapore market because they're reliable, they're mature companies, but there's also some structural winners that are out there as well. And I'd like to really focus on the last bit of the first point, right? Institutional certainty. This is something that a lot of investors maybe took for granted in the 2010s, 2000s, when we had politicians that were very much old school, like George W. Bush or his father, George H. Bush, and then Bill Clinton, and then Obama. So these kinds of characters, they're very much sort of part of the institutional makeup of what you would consider just very respectable. They respect the institutions that are there. And no one really thought anything about it because it was just the way it was done. It was the status quo. And then obviously Trump has really mixed that all up and has come in and he has his own way of doing things. It's a very populist approach. And it's thrown a lot of people off. It's given people a lot of unease about the market, about the strength of institutions like the Federal Reserve, the independence. I mean, the Federal Reserve, for example, has been independent technically since 1913, and the Federal Reserve Act was implemented to create the Fed, but also to make it independent from political influence. And now it's really enjoyed about over a century of that kind of independence. And now we're starting to question that now with Trump firing Fed governors and trying to push out Jay Powell. So this kind of interference is getting a lot of people a little bit upset and uneasy about the situation. And it's certainly not going to be good for markets. So that institutional certainty that we have in Singapore, I think is a really big asset that perhaps investors overlooked in the past 10, 15 years, but now is really coming to the fore and people are understanding this is an invaluable part of the investment landscape. Two structural winners. We know the new emerging large cap names that are benefiting from structural mega trends that are out there, the green energy, defense spending. I'll touch on a couple of these later. Small and mid caps are also starting to come back with the EQDP, which is the Equity Market Development Program, where the government is looking to inject about 5 billion into the local market. But there are some really interesting things happening in the small mid cap space as well. But there are different levers and different growth drivers, I think, for the Singapore market right now. But it's looking very, very positive for investors, and you also get a yield, which I think most people won't complain about. The contrast for me, I just like this picture because it shows Lawrence Wong, PM Lawrence Wong, who is really the epitome of institutionalism and, brought up in the civil service, were career politician. The real career politician knows what to say, has his own style of doing things, but really is a career politician. And Donald Trump on the right, which is just the exact opposite of a career politician. He was elected to sort of clean up the swamp and go in there and just mix things up. And that kind of character, you couldn't imagine ever coming close to office in Singapore. So I think these extremes, this contrast is an interesting example of the differences in perhaps management styles, but also in the way or the strength of institutions. And on the left, you have someone who really respects institutions and really wants to continue trying to push Singapore's competitiveness and recognizes how much the country has benefited from global free trade, no corruption, strength of institutions. And on the right, someone who wants to mix things up, has a bit of an ego, is very egotistical, is all about himself. Whereas on the left, you have someone that is really about consensus, right? Thinking about the next generation of leaders and how to plan for the next 20, 30, 40 years and not really to meet any short-term ego-driven goals, which a lot of the time President Trump seems to be doing. So for me, that was a funny contrast, which I thought summed up the differences between Singapore and the US pretty well right now. Okay, so I'm going to just cover a couple Singapore ideas, which I personally like, but also I think, has caught the eyes of investors. And if you do have any questions on what I've just presented or talked about, please do drop them in the box. And then again, obviously, if you have questions on my ideas for Singapore and the SGX, please do drop them in the Q&A box and we'll get to them in the end. Okay, so my first idea for me is Semcorp Industries, which typically had a very different type of business, say 10 years ago. But it got reinvented. So this is from its Investor Day presentation, actually in 2021, so 4 years ago. And this was looking at how it wanted to go from brown to green. That was the plan. It's typically in more dirty industries like gas and gas generation and fossil fuel generating power. But it started to build up a renewables business. And so it's looking to move away from the conventional energy business or not have so much of that make up its net profit. And it wants to move towards renewables and integrated urban solutions and support sustainable development. So a great worthy goal that also happens to be profitable. And so it's started to acquire more renewable energy assets in India, in China, in the Middle East as well. And the great thing about the company is that actually is signing what's called PPA, so power purchase agreements. And these tend to be long-term contracts that have fixed escalators within them, built within them, that allow the company to charge a certain tariff, a certain amount for power, and to continue to raise that in line with inflation or above inflation. And what it does is it gives the company a lot more revenue visibility further out, right? And that helps investors feel more at ease. And so the company itself is actually spun off Semcorp Marine, which is now Seatrium, because that combined with Keppel Offshore, its own division, its own marine division, and that's now called Seatrium. But it was weighed down, I think, prior to this sort of spin-off to by its marine and offshore division. So now it's really a pure play utilities business, which is great because we all know exciting times lie ahead for Asian renewables. There's demand in Asia for power. We know Asia generally is reliant on conventional fossil fuels, and so there is definitely a lot of runway to move towards renewables. It doesn't need to be right now, but year to year there is growth in Asia. Excuse me. And so there is a reinvention of sorts of Semcorp. Semcorp used to be a really messy conglomerate. And we all know as investors, we don't like conglomerates. I certainly don't because they have conglomerate discounts. If you look at some of the biggest conglomerates in Asia, they typically have property attached to something else, attached to something else. I mean, I'm from Hong Kong, so the Swire sort of Swire Pacific has always had a conglomerate discount just because it's so big and it's got property and it's got sort of consumer and it's got everything and it's just not really a good mix. It owns Cathay Pacific, so these kinds of conglomerates they tend to trade at a discount, and so to shed itself of the marine offshore, that was positive, and it's really started to take off since that sort of separation from its marine offshore division. And it's taking advantage of global megatrends, right? We know decarbonization, electrification, urbanization. So these are all three things that it's really focused on getting into. And so renewables is a big one, whether that's solar and wind. It's focusing actually a lot more on solar, and it's typically buying up projects or is agreeing with providers in countries such as India or China that demand electricity to build projects specifically for them. So they're getting a lot of positive momentum, I would say, on acquiring assets and acquiring projects over the past few years, and that's really driven growth. As there's still some juice to squeeze for dividends, right? I know dividends have been a part of the Singapore market, and actually Semcorp Industries itself, management has said it doesn't really want to be viewed as a dividend stock because prior to sort of 2022, 2021, as you can see, it didn't really pay much of a dividend. It was more growth, and it still is growth oriented now. But in terms of net profit, it's sort of flattened out a little bit from FY23 to FY24, pretty much flat. First half 2025 earnings were up, so about 1-2%. But its dividend is very, very well covered. So as you can kind of see on FY24, if you look at full year 20, FY20 to 24, it grew its dividend at a CAGR of around 50%, so 55% rather. And so that was actually faster than the CAGR of net profit. So the company is willing to pay out dividends and reward investors. And it's not put here, but in the first half of 2025, it released earnings early August, and its dividend was around its interim dividend was 9 cents, so that was actually 50% ahead of 6 cents, which was announced for the first half of 2024. So it's raising dividends quickly, and it's willing to return profits to shareholders. What I like about it as well is that the portfolio itself is pretty defensive. It's got a lot of projects in investment grade markets, 88%, as you can see, from investment grade markets of net profit is from investment grade markets. And it also has a big presence locally in Singapore. It recently upped its stake in Senoko Energy, which is a local power player, from 30% to 50%. So that should be earnings accretive this year for SCI. And Singapore is still the bulk of its profit, right? It's still very much a Singapore play, but there is opportunity in China, there's opportunity in India, there's opportunity in the Middle East with its projects that it's winning. And so it's got the dividend there that's stable, but it's also got the growth potential to continue to expand its bottom line. But as we know, right, we want to show me the money, right? Shareholders, Logan Roy here from Succession, money wins. So what does it mean in terms of where it's headed for shareholders? Well, cash flow is pretty robust, right? Cash flow is great. So I think that's looking really positive for investors. We can kind of see from cash flow from operating cash flow was up strongly in the first half of 2025 versus the first half of 2024. Dividends again were higher, but free cash flow at the bottom line, was also really positive. So I think free cash flows is continuing to grow. It's continuing to perform well, and so it's a positive sign for investors on the cash flow side, and that's what I like about Semco. And recently it had a massive correction. It corrected from about sort of close to $8, and it's down to around close to 610, I think 611 now. So it's down by around 20 something, over 20% in less than sort of 3 weeks. And so previously it wasn't actually a dividend stock. It was probably yielding around what, 2-3%. Post the correction of after first half earnings, which came in below expectations. There was a little bit of unhappiness, I'd say, with the profit numbers. I think 47-48% of consensus, not hitting that 50% mark, but it wasn't a massive miss. But it had gotten a bit pricey, a bit frothy. So it come down. It's down at around 610, 611 now, but it's actually yielding 4.3% on a trailing 12-month basis in terms of its dividend per share. So it's actually become more like a yield play now, if you're looking at it from a yield perspective based on a yield on cost at this point in time. And its dividend is well covered. Its payout ratios, I think, only around sort of 40%. So it's definitely well covered in terms of its dividend. So an interesting one, I think, for investors who like a bit of growth along with a bit of a dividend. Okay, number 2, ST Engineering. I think this is a good scene from again Succession with Greg and Tom. But I think this is how countries are feeling now that there's not the US security blanket covering them, whether that is Germany, whether that's a lot of countries in Asia, say Japan, Korea, South Korea. Politicians are not that happy with Trump's approach to alliances, but that's President Trump being himself. He wants countries to pay for their own defense. He thinks they should be fronting the money up. He doesn't think it should be unconditional. And so that's making a lot of people think, what should I do? What do I need to do? Like a lot of countries are thinking, we need to start putting more money towards our own defense. We need to start allocating our budget to defense because we can't rely on the US. They're not a reliable partner. And so that's what's been happening. And so it's also benefited a lot of ETF and thematics. And typically, I'm not a huge fan personally of thematic ETFs because a lot of them either launch to much fanfare on a very flimsy theme, or they just kind of fizzle out, or they're just not really going to outperform. And so this is a great chart from the FT actually, and from Morningstar. I looked at the top thematic ETFs based on annualized excess return versus benchmarks, okay, in since 2020. So you're taking a 5-year time frame. And most of them are rubbish. So the bottom six, as you can see in the red, is like food, nanotech, wellness, life sciences, and cannabis. Absolutely shocking. Negative 39% versus benchmarks. But defense is really the only one that really stands out. And it's because defense has had a really great run over the past sort of 4 or 5 years. And if you were invested into, say, anything like a Rheinmetall in Germany, obviously Palantir, although that's considered a bit more tech, not maybe perhaps not traditional defense, and ST Engineering, which is another defense company, but based in Singapore. And so these kinds of companies are gaining a lot of traction because there is business. People are spending, whether that's South Korean defense companies also building for clients in the Middle East or clients in Europe. ST Engineering is building for clients globally and is not just serving the Singapore government. So ST Engineering, had strong first half numbers, revenue up 7%, but net profit up at 20%, a good showing for the first half. It's had a very strong run in terms of its share price though, so it has corrected a little bit and come off its highs. But profit before tax and net profit up all in like double digits, along with EBIT and revenue just up 7% year on year. But CA, so this is commercial aerospace. It has three divisions: commercial aerospace, DPS, which is defense and public security, and then also USS, which is universal uh, services and SATCOM. So that's a different, very small part of the business. But CA and DPS are the main two parts of ST Engineering's bulk of the revenue. And so CA had a really good first half, steady revenue, strong EBIT growth on the top line, as well as the bottom line for EBIT for 18% year on year. Again, Defense Public Security Division had a really strong double-digit revenue and EBIT showing for the first half. And so, I think for investors, there's been a lot of interest and excitement because they've also been winning a lot of contracts and they've had a very, very healthy pipeline in terms of projects. As you can kind of see, contract wins for the first half up around just over 9 billion. And sequentially in the Q2, it was up from 4.4 billion in the first quarter to 4.7 billion in Q2. And defense and public security is the big one, right? 4.2 billion of contract wins. And so that's brought its order book to over $30 billion as of the middle of this year, with 5 billion expected to be delivered in the back half of 2025. So the order book's looking good. It's looking positive in terms of momentum. And again, dividends are something that are going to be dished out. So 4 cents, pretty stable. Hasn't been raising it as much as Sembcorp Industries, but it's still a reliable dividend payer. Again, post earnings sort of dip. It's yielding maybe like 2.3, 2.4% now on a 12-month look back basis. So total dividend was 8 cents for the first half, but management is maintaining that its guidance for a full year 25 dividend per share of around 18 Singapore cents. So that implies 10 Singapore cent dividend per share in the second half. So that should be 5 cents in each quarter for third quarter and fourth quarter of 2025 if management's guidance meets expectations. So this one's an interesting play on, I'd say, looking at defense spending, but also how the restructuring and realignment of global alliances. I think it's definitely going to benefit from that uncertainty. Okay, and then finally, I'm going to cover Sheng Siong. So Sheng Siong, a really very well-known local supermarket operator. So for those who may be not aware, in Singapore, there's Fair Price, which is one of the bigger chains, and Cold Storage, which is another big chain. But number three is Sheng Siong, and that has a really good presence in the sort of heartland. So the HDB blocks, there's always a Sheng Siong nearby. Um, and they're known for value, right? They're much more reasonable than Cold Storage and Fair Price as well. And they've managed to continue to grow revenue on a pretty consistent basis, right? As we can kind of see, first half 2025, revenue was up 7%, gross profit up even more, margins up slightly as well. It has a pretty very stable margin profile as well. Net profit margin was down slightly, but earnings up around 3%. Nothing exciting, nothing that's going to blow you out the water, but it's something that is very predictable. And in these times, I think that's something that a lot of investors are appreciating. Sorry, let me just move on. And it's growing organically, right? So retail area number of stores in Singapore hit 80 at the end of first half 2025. It's actually slated to open a record of 8 stores in 2025. It's already opened five. I think it opened another two in July, and it's going to open another one this quarter, in this current quarter. And so, oh, in the third quarter rather. And it's also kind of the starting to expand a little bit more its footprint in terms of where it sets up. It actually set up one recently in the CBD, in a CBD type of location, quite central. So a different type of vibe. So we can kind of see how that works out. I think they're experimenting, but on the whole, they tend to open in places that are very residential. People are within walking distance. Footfall is going to be big. And so they are one of those reliable operators. And even better, high cash balance, no borrowings. As you can kind of see on the cash side, it's built up a nice cash buffer there, around 370 million in cash, no debt, which is great. You love to see that. Very strong, very robust balance sheet. And so you really can't go wrong with a Sheng Siong unless, if there is people cutting back, they're going to be cutting back down to Sheng Siong from a cold storage or a fair price, if there is any further slowdown in the global economy. So yeah, so much advice. There you go. Singapore for me, I think basically means security and growth. There is a lot of talk about uncertainty, but in Singapore, there is a level of predictability. You know what you're getting. You know what is what the government and the markets think about the respect for institutions. And that to me is really an invaluable asset, as I said right now. So there is a lot going for the Singapore market right now, and hopefully you found that a useful take on Singapore. Do give me a follow. I am on TikTok and Instagram at Tim Talks Money SG. I like to share my thoughts on money, on miles, on investing. Hopefully, you can take something away from that. And do also sign up for my weekly newsletter at timtalksmoney.com. And I will get to questions. So, yeah, if we do have any questions, please do drop them in the box. I'm sure you have been dropping them in the box. But if you haven't, please do, and I will get to them now. And yeah, do give me a follow for more bite-sized insights. Okay. Um, I will get to questions in the Q&A box. Let me see what's been posted so far. Okay, so I don't think people can see the question, so I am just going to repeat the question, and then I will answer it. Okay, so Singapore, from Marcus, Singapore has got a relatively lower tariff rate than other countries in Asia. Would you expect an increase in FDI to Singapore from other countries to take advantage of this? Yeah, so I think this is also a question of of maybe this is an indirect question. I don't know if you know if you meant this, but in terms of transshipments, I mean, there's a lot of talk in the first Trump administration how there was a massive drop in maybe imports from China or imports from specific countries, but then there was a massive spike in some particular exports from Singapore to the US, and that was obviously them shipping it into Singapore and then it being shipped, basically just docking here and then shipping it again to the US and it counting as goods from Singapore. Um, I don't know in terms of the tariff rate whether that's going to impact it. I think the Trump administration's probably clued up to that kind of tactic by now. I think there was a lot of talk about potential secondary sanctions for countries that are shipping or transshipping from China or other massively sanctioned or massively tariffed countries. So in that sense, there's really not much point for FDI to be coming into this country, given how small it is and the manufacturing base just isn't big enough, I would say, to really get into to really manufacture at a large scale. You do have a little bit of manufacturing here, but it's just not on a scale that's big enough for most countries to want to invest, a massive amount of FDI. But we are seeing a lot of wealth funds like wealth flows into here, whether that's capital flows from family offices or corporates that are looking to invest in the workforce here, like on the financial services side or the tech side. That's happening. But on the good side, manufacturing side, I don't expect to see a massive increase in FDI, to be honest, from other countries because the Trump administration will be on the lookout for it, and so I don't think it's going to be as easy to pull off this time as it was, first time round 2018, 2019. So yeah, hopefully that answers that. Okay, I got a second question from Anonymous. Yeah, could you share some insights on F-34, so Wilmar International? So what happens if the massive security deposit is forfeited? How serious is the impact for Wilmar International? Okay, so Wilmar International, I think, is a hold on a minute, sorry, just get this out. Wilmar International a is listed here in Singapore, right? And it's a oh it's a joint venture from PZ Cussons. Okay, 50%. So this is not as much of a big holding, Wilmar, or as let's say prominent in the Singapore market. Um, Not sure what's going on with the security deposits forfeited. But hopefully we can answer that later. Maybe I can get back to you on that. Sorry, I can't help you on that at the moment. Not sure what the impact is for Wilmar. Okay, Nelson, any recommended Singapore fund? Singapore fund. So I think if you really want to just go into Singapore, actually from a investment perspective, one of the best ways to do that is really just to buy a Straits Times Index ETF on the Singapore exchange. That's probably the easiest thing to do. That's ES23. If you do ES3 rather, that's the Straits Times Index ETF from Spider. There is also a Nikko AM one, which let me just check the ticker for that. The Nikko AM STI ETF. Yeah, that's G3B. So there's ES3 and G3B, which is the Nikko AM one. There's similar types of expense ratios. So I like to look at ETFs that have lower expense ratios and do the job for you. I think recommended Singapore funds. I would say it's really difficult to outperform the Straits Times Index as a Singapore equity manager, just because if you've been underweight banks, which most have, just because they don't want to be too overweight the big three, you've underperformed. So that's been an issue. So I think if you're going to make a call on that, it's better to actually just like follow the index. for the Straits Times Index, which is 30, the biggest. And so you've got exposure to SemCorp, you've got exposure to ST Engineering within the STI anyway. So you could do that, but do note that if you buy the STI, you have about 50%, 52% exposure to the big three banks. But if you want to be exposed to the Singapore market, you can't really be exposed to the market without being invested in the Singapore bank. So it's pretty much you kind of have to be in the banks anyway. So for me, it's either ES3 or G3B, which is the Nikko AM STI ETF, and they pretty much do the same thing. The Spider one is bigger, but the G3B, the Nikko AM recently, I think just passed a billion in AUM. So it's getting big as well. So I think take a look at both. They do pretty much the same thing. Decide which one's the right one for you, and you can just purchase those on the SGX via via FSM1 and in Singapore dollars. Okay, so next question. With the three big Singapore banks hitting all-time highs, do you recommend to move some cash from bank stocks to REITs or ETF REITs instead? Yeah, that's a good question. I think there's been a lot of talk about this for a long time. Actually, back in 2024, if you remember, first half of 2024, there's a lot of talk about the Fed pivoting, starting to cut rates, and that maybe we should move from bank stocks into REITs instead because that seemed like a good time to pivot. If you did, you would have missed out on some massive gains in banks and you would have been way too early on REITs. So I think it's a bit of a difficult time to call it at this point. I've always said, Singapore banks were hitting highs, I think last year as well, and they just continued. I'm not saying they're going to go further and hit new highs. I'm just saying it's difficult to see there being a massive upturn in REIT share prices unless the Fed cuts very, very fast, like fast and furiously cuts, right? Because that's what really took the REITs to the woodshed was basically rates went up really quickly, really fast. So for it to benefit on the flip side, from 2022 when rates went up really quickly, that's when REITs got smashed. To really benefit and to really take off and rally, I think rates need to get cut very, very fast and it needs to be going down. But I don't know if we're going to see rates go back down to sort of 1%, sub 1%. I don't think we will. I think rates are probably going to settle around sort of 3% range, at least for the Fed funds rate. And so it's difficult to say on that sense whether this is a rally or this is a recovery that takes maybe 18 months, 24 months to play out because the rate trajectory is going to be much more smooth. It's not going to be down straight away. And maybe that's a good thing because I think if you're getting rates getting cut very, very quickly, that's probably a bad sign for the global economy and for REITs. So maybe perhaps it's better that we have a gradual decline in rates versus a really aggressive rate cutting cycle. But I would say trying to allocate or reallocate, it's a very much dependent on your own personal allocation and how you view it. I would say REITs are yielding pretty good in terms of there is like 5-6% on offer. But then banks are also yielding on an ordinary dividend per share, also yielding 5 percentage points, five-ish percent, right? So there's not a massive yield difference in what you're getting for the cash. But I would say it's difficult to find maybe as many REITs that are not cutting dividends, still cutting dividends at this point. There are some big ones that have still cut dividends in the first quarter, second quarter. But there are notable ones that have actually raised it, like Keppel DC. But they're more difficult to find. Keppel DC, Parkway Life, those really responsible ones, reliable ones that are going to continue to raise dividends. They've done well. But on the whole, it's a difficult time to try and time it, I would say. So I would avoid saying move some cash. If you do want to, maybe move a small portion of it and sort of space it out and see how that goes. But yeah, I would say like just hopefully that answered that question. It was a bit long-winded. Hopefully I answered it. Okay, I'm going to get to the last three as we're running out of time. Apart from the Singapore investing on clean energy, urbanization, healthy economic flows, are there any sectors that Singapore is going to invest at, in your opinion? Okay, so is going to invest in, right. So beyond clean energy, urbanization, healthy economic flows. Yeah, well, as I said, defense, that's one thing they definitely are doing. National defense spending, that's a big area. I think smart cities, I think electrification, AI, all these big themes. I think Singapore always wants to be in at the forefront of that. So I think infrastructure is one of those areas that will always be interesting, whether that's, fiber broadband infrastructure, AI, like data center infrastructure, that kind of stuff. There'll always be sort of investments into. Same goes for sustainability as well. Okay. In your view, what are the top five companies that we benefited from the $5 billion EQDP program? Well, to be honest, I think it's more small and mid-cap space. I'm a bit loath to kind of say this is the five companies that are going to benefit, but I think this is actually a better or more of a boon for the small and mid-cap space because it's going to bring a bit more visibility to that area, which has been neglected, I think, for a decent amount of time. But it shouldn't be because there are some really interesting companies operating in that space, doing really great things, doing well. We've seen some really good runs for a number of companies, like Food Empire, for example, has done really well. Marco Polo Marine's, done really well. There was Dynamac, which got bought out when took private. That did really well in the small mid cap space until it got taken private. So there are some really good companies operating in that area. So I think for me, that would just be the space to watch. And I think that will benefit the small mid cap space. And I think that's a great thing. Okay, so can you comment on Singapore Airlines share price and dividend? What can go wrong? Well, I think Singapore Airlines. What I have a problem with Singapore Airlines is, I mean, I love Singapore Airlines as a product. It's a great product. Obviously, a great airline. I just think for airlines generally, they have problems because they're cyclical. They have fixed costs, high fixed costs, and they have a lot of overheads to do with fuel hedging, right? Like, so they need to understand what they're going to get. So they have to hedge fuel costs, and that makes it sort of a drag on, I'd say, visibility or revenue visibility and profit visibility. So it's all dependent on load factors, how many people they're getting on bums on seats, et cetera, et cetera. Singapore Airlines has had a great sort of 2, 3 years. I'm not saying it can't continue, but typically maybe travel will wane. If there's a recession, travel will definitely drop off. They operate in a very competitive global aviation market with the big Middle Eastern carriers, some also like more competitive Asian carriers that are trying to ramp up the game, like Japan Airlines, Cathay Pacific. So I would say that for me, dividend wise, I don't like airlines generally because they're so cyclical and they have very high fixed costs. And to me, that just means it's more of a too difficult pile, similar to what Warren Buffett says. Even though Warren Buffett did invest, but then sold out, for me, it's just I don't really feel as though Singapore Airlines business model is changing drastically from maybe what it was like 10 years ago, 15 years ago. And I think airlines are finding that it's it's a it's difficult to attract long-term investors to airlines just because of these problems that they've always had with their business model. So for me, that's an issue that I don't think is going to change. So for me, that's why I'm a little bit more skeptical. But what can go wrong? As I said, recession. A recession will definitely hit Singapore Airlines and will hit business. Okay, could you share more on the small mid-cap landscape in terms of the market size, trading volumes? How do you anticipate the EQDP to play out? Yeah, so I mean, for me, the small mid-cap landscape is very selective. I mean, you really need to know what's going on in there to understand where you can see opportunity, turnaround plays, what's happening. There are multiple companies with sub $1 billion market cap, but there's also a couple, I'd say, I mean, small cap now, but in small cap could be a few billion, 1 billion, 2 billion. Trading volumes have not been great, to be honest, but they're starting to pick up. I think SGX is working with with the authorities as well to kind of push that space. And I think there's definitely going to be more research in the small mid cap space, which has been criminally just sort of undercovered. There's just a lot coverage for that space, which there should be, but it's been criminally undercovered, I'd say, from the research perspective. And so I think for research analysts, there's definitely more of an incentive to try and cover those names. There's definitely opportunity for investors, maybe short-term investors to take advantage of momentum plays, but also turnaround stories. There's some interesting turnaround stories as well in Singapore. So I think there's definitely definitely more opportunity for investors to get into it. But you do need to know what you're doing, and you do really need to to be familiar, I'd say, with the companies operating in the space as well. Okay, I think that's it, guys. Thank you for joining tonight. I think I've answered everything that's there. Um, for me, I think I will leave it to Mark to wrap up. So yeah, thanks for
Oh,
thank
okay. Thank you very much, Mr. Tim, for your presentation. And I believe that our audience that watching this and listening to your sharing probably have more clearer pictures and have some ideas on which areas they're looking at Singapore. And I think there's some questions that probably that the answer you answer the question will be helpful for them. And let's say, dear participants, let's say if you guys have more questions, just drop an email to our investhub.my@fundsupermart.com, and we will address you accordingly. Okay, so before we wrap up, I would like to highlight the ongoing promotion on FSM1 again, which is started on 18 July until 19 September. Okay, you can enjoy zero processing fee invest into a SGX stock or ETF in a SGD currency, and you are using a SGD auto sweep account. So later you can have a look on the our in the portal. And then the on 10th September 2025, there is a webinar as well on the title Crack the Market Code Singapore Sectors Playbook. Okay, this one will be presented analyst Alvin Chu. So he will be sharing an insight on which sectors in Singapore could be the key winners. So those who are interested probably can view the details in our FSM1 portal and register accordingly. So once again, I would like to say thanks to Mr. Tim for your presentation
thank
to
you.
tonight. Yeah,
Thanks
thanks a lot.
everyone. Have a good
Yeah.
evening. Thank you.
Yeah. Okay,
Bye.
yeah, bye. So, ladies and gentlemen, hope this session added value to all of you, and have a